Imagine walking into a store and spotting a once beloved product, bright packaging, bold promise, only to discover it's gathering dust on the clearance rack. You ask, what happened? Why did this product that once held so much promise simply die? Today, we're going to peel back the curtain and explore the hidden forces behind why products die. Understanding the depth of why products die demands more than data. It requires intuition, the ability to perceive the undercurrents that numbers alone cannot explain. Beneath every product's decline lies a web of interlinked causes, shifting consumer psychology, accelerating innovation cycles, and the invisible hand of disruption. The end of a product isn't just about sales falling off a cliff, it's about the erosion of relevance, the loss of resonance with a changing world. Most companies see decline as an event. It's not. It's a process, a slow fade that begins long before the final sales report confirms it. When a product loses touch with its market, it's rarely because people stopped caring altogether. It's because the product stopped evolving with them. The world moves in exponential curves, not straight lines. Technological adoption, consumer expectations, even cultural values, these all scale faster than legacy thinking can handle. And when leadership assumes that what worked yesterday will work tomorrow, they quietly plant the seeds of obsolescence. The death of a product begins with the death of curiosity. When teams stop asking what's next, they begin to fall behind the curve they once helped define. Think about how innovation shifts from breakthrough to background. What was once revolutionary becomes ordinary. The emotional spark that first captured attention fades into habit, and habits invite challengers. Competitors enter not with better marketing, but with better alignment, better timing, better empathy for what consumers now feel, not what they once needed. A great product doesn't fail because it was never great. It fails because the world evolved while it stood still. And the companies that ignore early signals of decline, the ones that cling to tradition instead of transformation, confuse loyalty with stagnation. Markets have memory, but consumers have momentum. They move forward, and they reward products that move with them. Understanding this depth means acknowledging that product life cycles are reflections of human behavior cycles. As people become more connected, informed, and demanding, the margin for complacency disappears. A single misread trend, a misaligned price point, or a delayed pivot can unravel years of brand equity. What once took decades to fade can now happen in a season. The digital economy doesn't forgive inertia, it amplifies it. This is where real understanding begins, not in analyzing decline after it happens, but in sensing it before it becomes visible. Data shows what's happening, depth reveals why it's happening. A true innovator reads between the lines, seeing the decline not as destruction, but as transformation in motion. When one product dies, another is being born. The energy doesn't vanish, it simply migrates to where attention and need converge again. The question is whether we can move with it, whether we're left defending a fading model. In every product's journey, there is a tipping point, the moment when incremental improvement no longer satisfies exponential expectation. It's in this moment that leaders must choose, evolve, or expire. Those who understand the depth recognize that decline phase can be repurposed into a launchpad for reinvention. When we see a dying product, we're really seeing an organization's ability or inability to reimagine itself. The more rigid the structure, the faster the fall. The more adaptive the mindset, the longer the relevance. True innovation lives in the margins of what seems uncertain. Understanding why products die is not about mourning what's lost. It's about decoding what's next. The world rewards those who look beyond the surface, who see in every decline the whisper of a new paradigm waiting to emerge. To understand the depth, we must not only analyze failure, we must empathize with it, dissect it, and learn from it. Because within every product's death lies the DNA of the future. In times of volatility, when markets swing between euphoria and despair, the temptation to be driven by sentiment rather than substance becomes almost irresistible. Yet, every meaningful transformation in business and technology has rewarded those who stay anchored in fundamentals. Sentiment is emotional. It follows headlines, narratives, and short-term noise. Fundamentals are structural. They reveal what is real, measurable, and sustainable. The distinction defines who merely survives and who leads when the tide turns. Understanding this balance requires conviction built on research, not reaction. When everyone else trades on fear, fundamentals become the compass guiding through uncertainty. Sentiment moves faster than facts, it amplifies perception and magnifies volatility. One announcement, one rumor, or one quarterly miss can swing sentiment violently, even if the underlying fundamentals remain strong. The market tends to price emotion in the short term, but value truth in the long term. That's why when sentiment collapses, it often creates opportunities for those who can separate signal from noise. True value doesn't disappear, it merely gets misunderstood. The most powerful moments of compounding often arise when the crowd is most skeptical and the fundamentals are least appreciated. Focusing on fundamentals means diving into the architecture of innovation, understanding the cost curves, adoption rates, productivity gains, and network effects that underpin transformative change. It's about asking whether a company or a technology is truly solving a problem more efficiently, more intelligently, or more inclusively than before. Sentiment might declare that an industry is dead, yet if the cost of innovation continues to decline and the productivity impact continues to rise, fundamentals suggest the opposite. History repeatedly shows that the most disruptive technology endures skepticism before validation. Consider how markets often misread innovation in its early stages. Sentiment dismisses what it cannot immediately measure, but fundamentals whisper truth before the world catches up. The underlying growth in user adoption, the acceleration of revenue per unit, or the drop in marginal costs, all are signals that sentiment tends to overlook in favor of dramatic headlines. The deeper one looks, the clearer it becomes. Sentiment is cyclical, fundamentals are directional. The former fluctuates with emotion, the latter compounds with time. Every correction, every downturn is a natural process of recalibration between these two forces. When sentiment runs too hot, prices detach from reality. When it turns too cold, opportunities appear hidden in plain sight. Investors and builders who understand this dynamic don't chase hype. They build during despair. They know that progress doesn't stop because sentiment does. Fundamental innovation continues quietly in laboratories, code bases, and boardrooms while the public narrative turns skeptical. Then, almost inevitably, the fundamentals assert themselves again, and sentiment swings back, too late. Those who lost conviction. This balance extends beyond markets into how organizations operate. Teams that anchor themselves in fundamental metrics, unit economics, scalability, sustainable differentiation, outlast those who manage by sentiment. The danger of sentiment-led decision making is its fragility. It crumbles when faced with data, but fundamentals are resilient. They withstand cycles, criticism, and crises because they are built on substance. Companies that endure understand their intrinsic value and adapt without abandoning core truth. They innovate from a foundation, not from fear. The essence of focusing on fundamentals over sentiment is patience combined with vision. It's recognizing that the future is built long before it's recognized. The market may not reward truth immediately, but time always does. Disruption doesn't follow the mood of the moment. It follows the trajectory of technological efficiency and behavioral adoption. Those who internalize this truth can remain calm amid chaos because they understand that volatility is merely the reflection of emotion, not erosion of value. When others see decline, fundamentals see evolution. When sentiments see collapse, fundamentals identify inflection. Those who master this perspective understand that conviction built on fundamentals is not stubbornness, it's foresight. It's the belief that while sentiment can distort perception, it can never rewrite reality. Time is the most underestimated variable in every market narrative. It's invisible, yet it determines everything. When innovation matures, when cycles reset, when confidence returns. In the world of investing and innovation, time is not the enemy, it's the amplifier. But most people misinterpret it because they measure progress linearly while true transformation compounds exponentially. Recovery is never immediate. It takes patience, conviction, and belief in underlying progress that often hides beneath surface-level noise. The greatest disruptions don't move in straight lines. They unfold through a series of breakthroughs, setbacks, and recalibrations that reward those who understand that time and recovery are intertwined. Every cycle has its rhythm. Markets rise not because sentiment improves overnight, but because innovation earns validation one milestone at a time. When capital retreats and valuations compress, impatient see decline, but the patient recognize recalibration. Recovery begins long before prices reflect it. It begins when progress resumes quietly, when fundamentals strengthen while attention drifts elsewhere. That's the paradox of markets. By the time the crowd realizes recovery is underway, those who waited with conviction have already positioned for it. Time doesn't just heal markets, it redistributes opportunity from reaction to resilience. Innovation rarely rewards immediacy. It tests faith in the long arc of progress. Every technological revolution, electric vehicles, artificial intelligence, genomics, blockchain, has endured periods where belief wavered and valuations collapsed. Yet, with time, the underlying reality always caught up to the vision. Recovery follows data, not emotion. As costs decline, adoption scales, and productivity compounds, the thesis strengthens. Time gives the truth room to emerge. What looks like stagnation in the short term is often acceleration hidden in the noise. Recovery is not just a rebound, it's a process of realignment. When markets overshoot, they correct. When narratives distort reality, they revert. The greatest recoveries are born from periods of doubt because that's when the weak hands exit and innovation resets to its true trajectory. Time cleanses excess, restores perspective, and clears the path for new growth. The ability to endure that period, to stay focused on the signals of genuine progress rather than the noise of short-term fear, defines the long-term winners. Think about how technology adoption curves evolve. In early stages, growth looks slow, too slow for those measuring quarterly results. But then, as awareness and infrastructure converge, exponential growth begins. Recovery operates the same way. It feels invisible, then inevitable. The market rarely prices recovery correctly because it demands something most lack: patience. Those who give time its rightful place understand that compounding is not just mathematical, it's psychological. It rewards discipline over emotion. When fear dominates, time appears to stand still. Valuations compress, conviction erodes, and the narrative shifts from optimism to doubt. But underneath, innovation continues. Engineers don't stop building because markets correct. Scientists don't stop experimenting because sentiment turns negative. The world doesn't stop progressing simply because prices fell. Recovery doesn't depend on emotion. It depends on execution, and time allows that execution to unfold without the distortion of temporary pessimism. The lesson is simple but profound. Time is the filter through which truth reveals itself. Recovery doesn't need permission from sentiment. It requires validation from fundamentals. The patience to wait through volatility isn't about passivity. It's about understanding that real value creation takes time to surface. The most transformative moments often come right after the darkest corrections, when innovation quietly proves its worth again. Those who respect time don't panic in decline. They prepare for recovery. They know cycles don't end in despair. They reset there. Recovery is never accidental. It's earned through persistence, clarity, and conviction that the forces shaping the future don't pause for fear. In the end, time rewards those who align with progress and penalizes those who chase noise. The market forgets, but time remembers, and recovery, no matter how delayed it seems, always arrives for those who never stopped believing in the power of long-term truth. Adversity is not the end of progress. It's often the beginning of reinvention. When markets tremble, when fear dominates, and when uncertainty clouds the horizon, opportunity quietly takes root. It's during these moments that conviction is tested and vision separates itself from noise. Throughout history, every technological and financial breakthrough has emerged from periods of doubt and discomfort. Adversity forces clarity. It strips away excess, reveals inefficiency, and redirects attention toward what truly matters. Those who see chaos as disorder miss its deeper rhythm. Within every dislocation lies the seed of transformation, waiting for courage to cultivate it. When conditions are difficult, the majority retreat. Capital becomes cautious, sentiment turns skeptical, and headlines reinforce fear. But that's precisely when value shifts beneath the surface. The crowd looks at what's breaking. Innovators look at what's being built. Adversity accelerates innovation because necessity demands it. When resources tighten, creativity expands. When markets punish complacency, adaptability becomes currency. The most powerful companies, ideas, and technologies of every generation have been born not in prosperity, but in pressure. The world's greatest innovations, those that redefine industries, are often forged in the fires of constraint. Opportunity in adversity comes from understanding that the same forces causing short-term pain are laying the foundation for long-term gain. When fear drives valuations below intrinsic value, patient capital finds entry points that hindsight later calls obvious. When the world obsesses over what's lost, the forward thinker invests in what's next. Adversity clears the noise. It dismantles illusions of permanence and reveals which models, leaders, and innovations truly possess resilience. In this way, downturns are not destruction, they're discovery. They reveal who is prepared for the future and who was merely benefiting from momentum. To see opportunity in adversity, one must detach from emotion and reconnect with fundamentals. Question isn't, how bad can it get, but what will emerge stronger because of this? Innovation doesn't stop because the environment is difficult. It accelerates because it must. The drive to solve bigger problems, to create more efficient systems, and to deliver greater value intensifies when conditions tighten. This is when vision matters most. Anyone can be optimistic in expansion. True conviction is revealed in contraction. Every cycle of adversity resets the playing field. Those who depend on legacy advantages falter. Those who embrace change rise. The dynamic shifts from scale to strategy, from visibility to viability. History has shown again and again that companies and technologies dismissed in downturns often become the next decade's leaders. They grow in silence while others retreat. When uncertainty dominates, execution becomes the differentiator. The innovators who keep building while others pause don't just survive the storm, they define the landscape after it clears. Adversity also deepens understanding. It teaches leaders to balance conviction with humility, ambition with discipline. It exposes weaknesses that prosperity hides and forces prioritization of what truly drives growth. The most forward-thinking organizations use adversity to restructure, refocus, and reposition for exponential recovery. They know that markets don't reward panic, they reward progress. While others are defending the past, the visionary is already investing in the future, aware that adversity compresses time. It accelerates the inevitable shifts that were already underway. Opportunity is not found by avoiding risk. It's revealed by understanding it. Adversity redefines the meaning of risk. It transforms it from something to fear into something to manage and master. The capacity to see through crisis, to stay grounded in data while others react emotionally, is where leadership is born. The innovators who embrace these moments don't simply adapt. They evolve, setting the stage for the next wave of value creation. In every cycle of fear, there lies a hidden symmetry. Adversity refines vision, and vision transforms adversity into advantage. The world doesn't advance in spite of difficult times. It advances because of them. For those willing to look deeper, every disruption becomes an inflection point, and every setback a signal of what's about to rise next.